Lesson 8. Comparing strategies in batch. Let me start with a situation that sounds familiar if you've been at this for any length of time. You've built 5 strategies. Each one looked promising on its own. You spent a week tuning the parameters on one. You copied another from a tutorial. A third was an idea you had in the shower. Now they're all sitting in your strategies folder, and you genuinely don't know which one to run with real money. So you do what most people do. You backtest them one at a time, scroll through each report, try to remember the numbers from the last one, and end up with 5 browser tabs and a headache. By the time you've seen the 5th report, you've forgotten the 3rd. There is a better way, and Freqtrade has it built in. Running them all at once, Freqtrade has a flag called Strategy List. You pass it the names of several strategies in a single command, along with your config, your time range, and your time frame. That is it. The bot runs each strategy in turn, backtests each one over the same historical period, and at the end it prints a single comparison table, all 5 results, same market, same period, side by side. This matters more than it sounds. The reason it matters is that comparing strategies only makes sense if they all saw the same market. If you backtest strategy A over January and strategy B over April, and January was a quiet sideways month while April was a raging bull run, you are not comparing strategies, you are comparing months. The strategy list flag forces everything to run over identical data, which is the only fair comparison. Now, an alternative is a shell loop. You write a small bash script with a list of strategy names, and it runs the backtesting command once, per strategy in a loop, logging as it goes. The reason you might do this is that you want each strategy's full report saved to its own file, or you want to inject some logging between runs. But for pure comparison, the strategy list flag is the cleaner choice, because you get the summary table at the end without doing anything extra. Reading the summary table so you've run the comparison, and now you have a table. The columns are roughly these: strategy name, number of trades, average profit per trade as a percentage, total profit over the whole period, win rate, meaning what fraction of trades closed in profit, and max drawdown, which is the deepest dip your equity took from a previous peak. Some setups also give you a Sharpe ratio, which I'll come back to. The default sort is total profit, highest to lowest. The strategy at the top is the one that grew your account the most over the period. Here is the honest part, and it is the whole point of this lesson. Total profit alone will lead you astray. It is one number, and it is the loudest one, but it doesn't tell you anything about how bumpy the ride was, how often you were right versus wrong, or whether the result is statistically meaningful or just lucky. You have to read several columns together. Let me give you a concrete example. Suppose your top strategy made 23% over the test period with a max drawdown of 3% and a win rate of nearly 90%. That is genuinely impressive. Now suppose another strategy made 19%, but with a drawdown of 4% and a win rate of 85%. The first one wins on raw profit, but the second one is barely different and might be simpler, more robust, easier to trust live. A third strategy made 15% but had a drawdown of almost 7% and a win rate of 72%. Looking at total profit alone, you'd rank it third. Looking at the whole picture, you'd still rank it third. But now you understand why, and you understand what kind of risk it took to get there. 3 ways to read the numbers. Different people want different things from a strategy, and there is no single right answer. The aggressive reader cares most about total profit. They're willing to tolerate a deeper drawdown if it means a higher return. For them, the question is, did the strategy clear some threshold of average profit per trade, say 0.8%, and did it clear some threshold of total profit, say 15%? If yes, it is a candidate. The downside is that high-profit strategies often come with higher drawdowns and can be fragile in changed conditions. They shine in the market they were built for and bleed outside it. The conservative reader cares most about not losing money. They look at drawdown first, then win rate, then Sharpe. A drawdown under 5%, a win rate above 80%, a Sharpe above 2.5. These strategies won't make you rich quickly, but they're less likely to terrify you, and they tend to be the ones you can leave running while you sleep. The balanced reader, which is most of us, wants both. Decent profit, controlled drawdown, healthy win rate, reasonable Sharpe. The trap with the balanced reader is that you can convince yourself almost any strategy is acceptable, because nothing looks extreme. You need a way to combine the numbers into a single judgment, which is where scoring comes in. A scoring system here is a simple approach. Give each strategy a score out of 100, where the score is a weighted blend of 5 things. 30% of the score is profit, 25% is risk, meaning how small the drawdown was, 20% is win rate, 15% is Sharpe, and 10% is trade frequency. The exact weights are a matter of taste. You might bump profit up if you are aggressive, or risk up if you are conservative. What matters is that you commit to weights before you look at the results, not after. The whole point of scoring is to remove your feelings from the ranking. If you adjust the weights until your favorite strategy wins, you've defeated the purpose. A couple of details matter. For profit, you should cap it. A strategy that returned 60% in a backtest shouldn't score twice as high as one that returned 30%, because extreme backtest returns are usually a red flag, not a green one. For drawdown, you also cap it, somewhere around 10%, so that a strategy with a 4% drawdown doesn't score dramatically better than one with a 5%. For Sharpe, cap it too, around 5%, because Sharpe ratios above 5 in a backtest usually mean the strategy is overfit or exploiting a data quirk. The trade frequency piece is the one people forget. You don't want a strategy that trades too little, because then your sample size is small, and the result could be luck. If a backtest over 3 months only produced 8 trades, you genuinely don't know if the strategy works. 8 trades is noise. You also don't want a strategy that trades too much, because every trade pays a fee and spread, and high-frequency strategies often look profitable in a backtest that ignores real-world slippage, and then bleeds slowly in production. The sweet spot is moderate, somewhere between 10 and 80 trades over a month, depending on your time frame. So you run all your strategies through this scoring, and now you have a single ranking. The top one isn't necessarily the one with the most profit. It is the one with the best balance of profit, risk, consistency, and statistical reliability. Filter before you rank one more step before you trust the ranking. Set hard cuts and throw out anything that fails them, no matter how it scores. A reasonable set of cuts looks like this. Total profit below 5%. Out. Max drawdown above 15%. Out. Win rate below 50%. Out. Sharpe below 1. Out. These aren't magic numbers, but they catch strategies that look okay on one metric and are actually broken. The reason this matters is that a strategy can score surprisingly well on a weighted blend while still being fundamentally bad. Maybe it had one giant winning trade that carried all the profit and 10 tiny losing ones. Maybe it ran up huge games early in the backtest, and then slowly gave them back. Maybe it only worked because of one specific 2-week window. A strategy that can't clear a 50% win rate or a Sharpe of 1 is not a strategy you should be running with real money. No matter what its blended score says. After the cuts, look at the survivors. Check the distribution of exit reasons if your backtest reports them. Are most exits hitting the take profit, or are most hitting the stop loss, or are most hitting some trailing stop or timeout? A strategy where 90% of exits are stop losses, but it still made money is suspicious. Check the holding times. Are trades held for minutes, hours, days? Does that match what you expected from the strategy's design? A trend-following strategy that holds trades for 40 minutes isn't trend-following. Something's off, markets change, and so should your strategies. Here is something the comparison table won't tell you. Every result is conditional on the market it was tested in. A trend-following strategy will look brilliant over a stretch of clean bull market. A mean reversion strategy will look brilliant over a stretch of choppy sideways price action. Run them over the wrong market and they fall apart. Trend followers bleed slowly in range-bound markets, getting whipsawed in and out of trades. Mean reversion strategies get run over in trending markets, shorting into a rally that never reverses. So, a meaningful comparison tests strategies across multiple market regimes. Take your historical data and chop it into pieces. There is the bull phase, where prices rose steadily. There is the bear phase, where they fell. There is the sideways phase, where they bounced in a range. Run every strategy over each phase separately, and you'll see something interesting. The strategy that topped the leaderboard overall might have made all of its money in just one of those phases and lost money in the other two. Different strategies are tools for different jobs. Trend, following, and momentum strategies are bull market tools. Mean, reversion, grid, and Bollinger Band reversal strategies are range-bound market tools. Breakout strategies work in markets with clean directional moves. None of them works everywhere. If a strategy's documentation claims it works in all conditions, be skeptical. This is also why the question of which strategy is best has no answer. The best strategy depends on what the market is doing, and what the market is doing changes. The practical response is to run more than one strategy, each tuned for a different regime, and size them so that when one is struggling, another is likely doing okay. Building a portfolio so once you've compared and scored and filtered, the temptation is to pick the single best one and turn it on. I'd encourage you to resist that. A small portfolio of strategies, 2 or 3, each targeting a different kind of market, tends to be more robust than one strategy alone. The reason is the same as diversification in any other part of investing. Uncorrelated returns stack more smoothly than correlated ones. If your trend strategy is having a bad month because the market is sideways, your mean reversion strategy might be having a good month for exactly the same reason. The equity curve of the combination is smoother than either curve alone. The catch is that you have to be honest about capital. Running 3 strategies doesn't mean tripling your position size. It means splitting your capital across them, so each one is taking less risk per trade. The point of the portfolio isn't more return, it is more stability. And one last honest note. Even with scoring and filtering and portfolios, you are still looking at backtested numbers. And backtested numbers are optimistic by construction. They assume perfect execution. No slippage beyond what you modeled, no outages, no rate limits. Real life performance will be worse than the backtest. Sometimes a little, sometimes a lot. The comparison table tells you which strategies are promising relative to each other. It does not tell you what they'll actually deliver. Treat the absolute numbers as a ceiling, not a promise. Wrapping up, so that is the workflow. Run the comparison with strategy list over a fair identical time range. Read the summary table with several columns in mind, not just total profit. Pick weights for a scoring system and stick to them before looking at results. Apply hard cuts to throw out broken strategies regardless of score. Check the survivors for weird exit distributions or mismatched holding times. Test across multiple market regimes, so you know what each strategy is actually built for. And finally, consider a small portfolio rather than a single champion. The mindset shift in this lesson is the important part. Beginners look for the strategy with the highest return. Experienced traders look for the strategy whose numbers hold up across many conditions, whose sample size is large enough to trust, and whose risk profile they can live with. The first one chases the leaderboard. The second one builds something durable. In the next lesson, we'll take a single strategy and stress test it across different time ranges, so you can see for yourself how much the result depends on the window you happen to pick. That is where overfitting stops being abstract and starts being something you can actually catch.